Hedge fund manager Bill Ackman just released his latest Form 13F, revealing all the moves in his portfolio in the recent quarter. And while there's very little activity in the recent quarter, he's enjoyed gains from positions like Google, Brookfield Corporation, and Uber in the last year. But what really struck me is what Bill Ackman just stated the other day in an interview on Fox News. I'm going to go ahead and play the clip.
It sounds like you're bullish going into the new year. Are you poised to put new money to work in equities going into 26?
Yeah, look, I think it's been an interesting market. You've had some enormously successful companies that have generated huge returns this year. You've had a lot of stocks that are down a ton. So I think it's a very good market for stock pickers. You know, we're very concentrated investors, and we're seeing some very high quality businesses showing up at very attractive prices. And so we'll absolutely be putting money to work. We've actually got approaching 15% cash, and we're looking at a number of very interesting things.
So what would it take for you to put that 15% cash to work? A big sell-off?
No, just finishing our due diligence on a company we really have wanted to own for years, now available at a bargain price, something like that.
Now, there's plenty we can break down about what Bill Ackman just said, but he stated he's sitting on a 15% cash position because they're close to buying what he calls a high-quality company at a bargain price. But before he even said that, he said this is a stock picker's market. Now, the reason this is a stock picker's market is because, yes, while the S&P 500 is pretty much at all-time highs, the vast majority of these gains have been from the Mag 7 stocks. So what this means is if you look at the market as a whole and valuations of the market as a whole, you'd probably be scared from investing in equities. But if you start to break it out and look at individual stocks, there's massive opportunities right now. And as Bill Ackman stated, he's sitting on a 15% cash position that he's about to put to work. Now, Bill Ackman is very transparent about his strategy. He claims that he looks to invest in simple, predictable, free cash flow generative businesses. He wants barriers to entry, a strong balance sheet, limited exposure to extrinsic factors that we can't control, and of course, he wants them to be trading at an attractive valuation, and ideally, he wants them to have a large market cap. So when we take this into consideration, as well as the fact he's looking to buy stocks on a discount, there's really only a handful of stocks that he could be looking at right now. And in my opinion, I think it's one of two potential opportunities. Let's look at both of them. And the first is Mastercard. Mastercard is in a quite unique position right now, at least compared to how the company has historically traded. Now, if we go ahead and jump over to the stock valuation sheet and look at Mastercard, if we look at the historic multiple valuation and go ahead and zoom in, we're looking at the historic PE multiple. We can see right now they're trading about 8.5% below how they've historically traded. But this gets even more interesting if you look at them on a price to cash flow basis. Look at this. Right now, Mastercard is trading at its lowest price to cash flow multiple in over 3 years. And on top of this, if we compare them to their peer Visa, historically speaking, there's been a bit of a valuation gap. Now, why is that the case? Well, historically, Mastercard has grown earnings and free cash flow at a faster rate, which means that valuation gap is somewhat warranted. But that valuation gap has completely closed, and they're now trading at near identical levels. But despite the valuation gap closing, what hasn't changed is the growth projections. Let me show you what I mean. If we jump over to our stock comparison sheet and look at Mastercard compared to Visa, and we can see all this data will load in. Now, there's plenty of things we can break down here, but here's what we need to pay close attention to. Look at the projected 3-year EPS CAGR. Mastercard is projected to grow earnings over the next 3 years at about 16.4%. Visa's projected at 12.5%. So despite trading at near identical valuation levels now, Mastercard is projected to grow earnings at a significantly faster rate. Now, obviously, there's multiple things we can account for when it comes to valuation, but at its simplest level, valuation is simply looking at how much you're willing to spend for each dollar of earnings of the stock, and then looking at how fast earnings are projected to grow in the future. And so when you compare Mastercard to Visa right now, Mastercard certainly looks like the better opportunity, and that's coming from someone who's owned Visa and has loved Visa for a long time now. And Mastercard certainly falls under the category of quality that Bill Ackman is looking for. For example, if we look at Mastercard on the stock screener, you can see all this data will load in. And real quick, if you'd like to be able to download any of these spreadsheets that you've seen in my videos, and if you'd like to get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials directly into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Right now, we're running a Black Friday sale where you can get 30% off and a 7-day free trial on any of the yearly plans. Ticker Data is truly one of the most powerful stock analysis and portfolio tracking tools out there. If we look at the attributes, you can can pull in income statement metrics, statement of cash flow metrics, balance sheet data, and a lot of other key metrics directly into your spreadsheet, and we have over 30 plus years of data. And on top of this, if you're an international investor, then ticker data is your dream. You can pull in data on stocks from over 70 plus different stock exchanges all across the world, from Egypt to Finland to Germany, Hong Kong, Hungary, India. The list goes on and on. So just use code BLACK at checkout to get the 7-day free trial and 30% off yearly plans. Now, if we look at Mastercard, we can see revenue per share has gone from $8.10 to, in 2024, $30.84. So nearly a 4x in just a 10-year time period. The same is true with earnings and free cash flow. But here's what I love about this business. Look at return on invested capital, one of the key indicators of a high-quality stock. What type of returns is the business getting on the capital it reinvests back into the business? And typically as a baseline, you want to see around 10%. The high-quality stocks get 20%. Mastercard has been above 40% for 3 consecutive years in a row, and essentially above 30% for the entirety of the past decade. This was Charlie Munger's favorite metric to look at, and it's really what makes a stock a quality compounder. Now, obviously, on top of this, what I love about Mastercard is how incredibly capital light the business is. Look at these margins. Last year's gross profit ratio was at 76.31%. So the margins are extremely high. And if we just look at the different business segments for Mastercard, not only are they projected to grow at a high rate as we saw earlier, but historically they've grown incredibly fast. We can see the domestic assessments portion of the business. This is essentially fees charged to cardholders when they make purchases inside their own country, and it's up about 6% year over year. Then we have cross-border volume fees. This is up 18% year over year. And this is fees charged when someone uses Mastercard outside of their home country. Then we have transaction processing, which is basically when Mastercard gets paid every time a card is swiped or a bank approves a transaction or data moves across their network. But what a lot of people are missing about Mastercard right now is their value-added services and solutions. This is starting to be one of their largest business segments at about $3.4 billion, and it was up 25% year over year. That makes it Mastercard's fastest growing business segment, and this is going to include things like cybersecurity tools, fraud prevention, consulting, loyalty and reward programs, as well as analytics services. This segment has become a huge growth driver for Mastercard. So all that to say, even though this company is already at a market cap of nearly $500 billion, the growth runway is still large. And it certainly falls under the category of high quality that Bill Ackman is looking for. And again, notice how he says he wants predictable free cash flow generative businesses. When we look at the history of growing free cash flow for Mastercard, we can see the company has a 10-year free cash flow CAGR of 16.6%, going from about $3 billion in free cash flow in 2014 to in 2024, $14.3 billion. And we can see every single year, free cash flow continues to grow very predictably. And as a result of this, they're able to grow the dividend at an extraordinarily high rate without the free cash flow payout ratio growing over time. So yes, Mastercard is undoubtedly a quality company. And if we look at them year to date, they're only up by about 2.5%. Now remember, anytime a company is growing earnings faster than the rate that their share price is increasing, what does that mean? Well, it means the valuation multiple is drawing back. In other words, that means the price to earnings multiple is decreasing, creating a more attractive valuation. So the question is, what type of returns can we expect from Mastercard as we move forward? Well, let's look at our sensitivity analysis to break this down. Now, to project future returns, we need to enter a future PE ratio and a projected EPS growth rate. Now, like we saw earlier, the next 3 years, EPS growth is expected to be about 16.43%. So let's just assume that they achieve that. That's the average analyst rating. We'll go with 16.43%, but now we need to project our PE multiple. Now remember, they're currently trading about 8.3% below the historic average PE multiple. So let's just assume it stays exactly where it is and stays below the historic average. What type of returns would we get from this stock? Well, we can see by the year 2030, it'd give them a share price of $1,207 or a total return of 123.5% and a compounded return of 14.3%. Now, remember, this is certainly not a best case scenario, but it's obviously not a worst case scenario as well. Let's significantly reduce this PE multiple that they could trade at. Let's bump it all the way down to around 27, which would be by far the lowest PE multiple they've traded at in over the last decade. Even with a PE multiple at 27, we can see by the year 2030, we're still looking at compounded returns of nearly 10%. And keep in mind, these don't include the dividends, which the yield is low, but the dividend growth is going to be high. So from a risk-reward perspective, Mastercard has certainly become interesting. I think this is one that could be on Bill Ackman's watch list. Now, the second opportunity I think Bill Ackman could be considering right now is Meta stock. Meta stock has sold off significantly in the last month, down by nearly 17%. If we look at the average analyst price target right now, they give Meta 37.5% upside with a price target of $838.14. Now, why is it that Bill Ackman might be considering Meta? Well, they obviously have many quality metrics, and they've grown revenue per share at just a mind-blowing rate over the past decade, over a 10x. But we also have to remember, Bill Ackman has a large position in Google stock, and Google stock generates the majority of their revenue in the same way that Meta does. Advertising revenue. Now, Google's obviously a much more diversified business than Meta overall, but that's still the core of the business model. And that's the exact same business model that allows Meta to be quite capital light, somewhat similar to Mastercard. We can see return on invested capital is quite high, and if we look at the profitability sheet to look at those margins, we can see last year's gross profit ratio came in at 81.67%, which is actually even higher than the 5-year average. So anytime you have revenue growing at an 18.4% compounded annual growth rate combined with the fact that margins are expanding, you're going to get explosive earnings growth, which is exactly what's happened with Meta. Now, if we just quickly look at the valuation for Meta, let's plug in the ticker. And before we move forward, if we just look at the historic price to PE multiple ratio since 2018, we can see it's drawn back considerably. It's now sitting below 20 at about 19.89 times earnings. And despite trading at a lower PE multiple than the S&P 500, we can actually see that Meta is projected to grow earnings at a pretty fast rate. In fact, if we look at the average analyst EPS estimate through the year 2029, Meta has a projected EPS CAGR of above 15.6%. So they're trading at below 20 times earnings and projected to grow EPS at above 15.6%. I'm already starting to like the way this sounds, but let's just run them through a discounted cash flow analysis model. Now again, what we're trying to do is project the future free cash flows of the business to see what the company is worth. And to do that, we need to project a growth rate to the future free cash flows. So let's be somewhat conservative and go with 12%, which again is below expectations. We apply that 12% free cash flow growth rate to the present value of those future free cash flows, add the future free cash flows together, add cash and cash equivalents, and subtract out total debt to get equity value, divide by shares outstanding, and we come to a DCF price per share of $670, which gives them about 10% upside from their current share price. But again, we're definitely not pricing in their best case scenario. Free cash flow growth rates of around even 14.5% is absolutely attainable for this stock, which would give them a price target of close to $800 a share, or around 31% upside. So just running it through a quick model, all of a sudden, you can easily see why the price target for this stock is so much higher than what they're currently trading at. So what was the reason for the huge sell-off? Well, the earnings report was actually decent, but what people were scared about was their heavy CapEx spending. Meta has a history of overspending on CapEx, especially back in 2022, which is when we saw a major sell-off of the stock, going from around $377 all the way down to around $90 a share. But nonetheless, the stock clearly recovered and continued to grow revenue, earnings, and free cash flow at a high rate. So to me, this looks like another opportunity brewing. So while there's certainly a multitude of stocks out there that Bill Ackman's Perishing Square Capital could be looking at, if I was forced to make a guess, based on the criteria he gives us with his core investment principles, I think the two potential stocks could either be Mastercard or Meta. They're quality stocks that have seen a bit of a drawback, and they have some similarities to stocks that he's added in his portfolio in the past. But go ahead and let me know what you think of these companies in the comments down below. And again, if you want to get access to the Ticker Data Black Friday sale, be sure to use code BLACK at checkout to get 30% off and a 7-day free trial. But with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.